What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about the everything credit bubble that apparently got started in 2008, right after the great financial crisis. I'm going to break down this report that I read earlier from one of the economists that has a very, very good reputation for calling out for market crashes and signals for market sell-offs as well. So he's pretty much written a report talking about how there is a lot of speculation, a lot of frothiness in the market right now, which could result in not a great outcome for the markets. So we're going to break that down. I'm going to share my perspective and my opinion on this market as well. So hope you all enjoy this video and find it helpful. I would really appreciate you dropping a like and subscribing to the channel. It really helps us out in a great way and pushes this video out to more people that might be interested in joining our MoneyVest community. And of course, you can access all the links down below for our Patreon. So members only private videos. There's limited spots left for the month of December. I open up a few more spots if you're interested in joining. Full access to spreadsheets, including my watch list, intrinsic values, my fair values on individual stocks, and what I'm planning to do with my alerts. So in other words, trade alerts, ideas, and buy and sell signals. Everything's going to be included with the link down below as well. And also do check out the courses. So lifetime access to all the fundamental, technical, options, and psychology course. These are super educational and lectures and tutorials, over 130 plus videos and 30 plus hours of content, and new content is being added on a regular basis. And also do connect with me on Instagram as well if you want to connect with me there, and of course track my personal life and also get updates on portfolios and other strategies and polls and tips. Everything's going to be included there as well. So the Fed watcher who called the 07 housing bubble expects interest rates to stay higher for much longer. It's payback for the unsustainable free money era. And this is Jim Grant, and he has been tracking the ins and outs of the Federal Reserve policy and its effects on the economy and the markets in his famed newsletters. He's got a newsletter called Grant's Interest Rate Observer for over 40 years. And the always bow-tied and often staunchly skeptical economist historian has made a name for himself with some pretty good prophetic forecast ahead of the past financial calamities, including the global financial crisis as well. So he did call out, he did issue a lot of warnings back then in 07 for this free money era when interest rates were really low. And of course, eventually that ended up being a very, very over-leveraged housing market, and there was a bubble, which obviously did burst to what we already know as the Great Financial Crisis. Now, in an interview with Fortune, Grant lays out his fears that another potential disaster is on the horizon. Those are his words. And after roughly a decade of near zero interest rates, he argues the U.S. economy developed a debt problem. Now, look, when I go over these topics, when I go over these reports, it's not me who's talking about these things, because I do kind of come across a couple comments sometimes that I'm making a bearish video. Folks, this is literally reports from some of the most popular or the most looked out at historians, economists, and strategists, and they're the ones talking about this. I'm dissecting it in a way that's a little bit better to understand, and I'm also sharing my thoughts along the way on what I agree or disagree with and what are some of the risks and rewards in the market right now, looking at the current environment and the opportunities. So that's what we're doing. We're looking at another person's report and I'm analyzing it the best I know how. So after roughly a decade of near zero interest rates, he argues the US economy developed a debt problem, one likely to end badly now that higher interest rates are here to stay. The inevitable fallout from the end of the free money era has yet to be felt fully, is what his warning is all about. So essentially what he's saying is that the US is on a very I would say like on thin ice with respect to debt, and it has developed a debt problem after having over 10 years of lower interest rates, and a potential disaster is on the horizon. And he calls this the quote everything bubble and its consequences as well. And he basically says that, you know, after the economy got absolutely destroyed in 2007, 2008 because of the great financial crisis, the Federal Reserve held interest rates near zero. So basically they got cut down to really low levels, and they instituted a policy called quantitative easing, which you're all aware of, where it bought government bond securities and mortgage-backed securities in hopes of spurring lending. So when the Federal Reserve buys a lot of government bonds or MBS products, what they do is they create this artificial demand, and as the demand comes in, bond prices go up, yields come down, or they artificially are kept down so that cost of borrowing is low and people are able to spend, save, and borrow. Eventually, of course, together with these policies, created what is known colloquially as the free money era, pumping trillions of dollars into the economy in the form of low interest rate debt. And Grant has long argued the Fed's post-Great Financial Crisis policies helped blow up an everything bubble in stocks, real estate, and everything. And even after equities' rough year in 2022 and real estate's 2-year slowdown and a regional bank crisis this March, he still fears that the bubble has only partially deflated at the moment. And after years in which corporations and as well as consumers and governments rapidly increase their debt loads, Grant worries many will soon be unable to keep carrying that debt because, of course, we have the volatile banking, commercial real estate sectors have been hit hard by rising interest rates. He still believes the private sector, including individuals, households, and even companies, are not going to be able to keep up with this because the consequences of more or less 10 years of proverbially free money is going to play out in the credit markets as well. And he also called a lot of these zombie companies as examples that they are going to face a lot of issues once the floating rate starts to jump higher and their interest expense is going to be much higher, and there's a slowdown in overall economic growth and revenues and earnings and profitability. They're not going to be able to finance a lot of this debt, and WeWork is a prime example of a company essentially going under on the back of a very, very failed business model and, of course, tons of debt that they took on during this free money era as well. To his point, and we also did analysis on this in one of our previous videos, right? So I talked about how there's increasing corporate bankruptcies in the US, and according to S&P Global, as of September, there were over 516 corporate bankruptcies and more than any full year data going back as far as 2010. So in over 13 years, we've seen the most U.S. corporate bankruptcies, which rose nearly 30% from a year ago in September. Federal court data is also showing. So that just goes to show that we are certainly going through an environment where the overall market's going to start to consolidate more and more towards the bigger tech, the Magnificent Seven, companies that are well capitalized with a lot of cash, a lot of moat, and a lot of advantage and dominance in the overall sort of sector that they operate in. And the bubble years, so Grant is just one of several well-known names in finance who fear the free money era created distortions in the economy that have yet to correct themselves. And Mark Spitznagel, again, mispronunciation on my part probably, but the founder and chief investment officer of the private hedge fund Universe Investments, also mentioned that the Fed's post-Great Financial Crisis policies have created the greatest credit bubble in human history, is also what they mentioned. And we've never seen anything like this level of total debt and leverage in the system. It's an experiment, but we know that credit bubbles have to pop, and we don't know when, but we know they have to. And this is actually quite an interesting line over here, that it's an experiment, right? It is indeed an experiment because nobody really knows what the end game is here. Like, okay, there's some analysts suggesting that there is potential disaster on the horizon, and this is not going to end well. Everything bubbles, taking all the prices, stocks, real estate, equities, bonds, everything pushing higher. But on the other hand, there's consensus that, okay, even if there is a credit bubble, there is a possibility for us to push past it, for the United States to figure itself out, for large cap tech companies to continue to provide the stronger economy and the economic growth and the market returns that we have accustomed to seeing in the past. So it is an experiment. At the end of the day, it is an experiment. I don't have all the answers, neither does anybody else, because we're going through a process which we haven't really gone through in ever, especially when you consider the size and scale of the US economy with respect to the levels of debt and with respect to the interest rates that are now higher for longer after such a long time, which is exactly what he talks about, that history says higher for much, much longer. And Grant stands out from Wall Street. PAC is another respect, and that is to say that many Wall Street analysts are expecting Federal Reserve to start cutting rates in 2024 at some point, but Grant predicts an era of higher rates that could last a generation. And by generation, he means 40 years, because he basically says that historical reading of monetary policy argues that we're in for a generation of rising interest rates with some volatility in between, and the phrase would be higher for much, 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 much longer, but we have to underscore and italicize the conditional if past is prologue, right? So if past is any type of guidance into the future, what he's saying is that since 1981 to 2023, barring a few brief blips, the interest rates continuously trended down. They were on its way down. And before 1981, so the prior 40 years before that, they were essentially trended, again, with a few exceptions, in the opposite direction, moving higher. So what he's saying is that there is a generational long interval for the bond market where 40 years it's trending higher, 40 years it's trending lower, and now we're coming towards the end of that cycle, in other words, into a new regime where interest rates are going to be, according to Grant, for the next 40 years, going to be trending higher for much longer. And if that's the case, obviously it's going to create a lot of pressure, a lot of stress in the economy, given how high levels of debt we have. There's a lot of zombie companies, and equity prices are going to be subject to competing with those bond yields as well. So that's the entire report, which again, maybe there is some truth to that. And of course, Cathie Wood has been very vocal with the deflationary technology and how technology is kind of creating this deflationary environment where inflation is going to be lower, and as a result, interest rates could be lower. And Grant admitted that technological progress can be deflationary, but it's not clear that the current rate of progress is fast enough to bring down prices substantially. Looking back at history, he noted that there have been periods where the US economy was undergoing rapid transformation, but prices were still rising, meaning innovation and deflation don't always coincide with each other as well. So where does that leave us with where we are in the current environment? So here's my take. I've listened to Ray Dalio quite extensively, and I've read a lot of his work, and I've also listened to Peter Schiff, and I've listened to a lot of other economist forecasts, and of course we look at Tom Lee and Dan Ives and all the other analysts and strategists to get a good perspective on the overall markets and the economy as well. This is an experiment, right? When it comes to the level of debt, when it comes to the interest rates, when it comes to the fiscal policy from the United States, it is an experiment. Nobody has the answer for that. But when it comes to the market in general, we know that it's very much to do with tail events and concentration, because if it weren't for Magnificent Seven, right, the markets would not be going anywhere, right? If it would not really be up on the year, let alone would have increased substantially as it has over the last, I would say, 10, 20, 30 years. Now, were lower interest rates a big contributor to those gains? Absolutely. Absolutely. There's no question about it, right? Interest rates staying lower for longer was one of the biggest sort of catalyst for driving this entire bull market post Great Financial Crisis up until now. Now, of course, moving forward, there's going to be a lot of speculation that we're in for a lost decade. We're in for higher for longer interest rates. We're in for a soft landing. We're in for a very hard landing. We're in for a credit bubble or an everything bubble. So there's always going to be something to worry about, right? As Peter Lynch says, there's always going to be something to worry about that's going to force you to not invest, right? It's going to pull you back from not investing. For me, understanding that overall economy, overall global economy, and of course even the markets are going to create value and they're going to grow, they're going to do well in the long term, especially when we talk about some of the best quality companies in the world. They're going to grow and they're going to do well. I'm not going to shy away from investing, right? I'm going to continue to dollar cost average. I'm going to be consistent with my investing philosophy. Now, when it comes to looking at opportunities, yes, I can be a little bit more active and a little bit more tactical on where I would want to put my money moving forward. I'm also looking at emerging markets. As you guys know, got a pretty solid portfolio here in India, and I do share that with all of our members only videos. So Patreon members do get to access and see in certain videos what I actually have in my Indian portfolio. I've done videos on that. So if you want to get access to that, link's going to be down below. But in the meantime, I'll always be evaluating the current situation, right? Instead of forecasting and predicting for the future, I'll be looking at what the situation is today and how we can take advantage of the opportunities that are in the market in the present day, instead of just kind of predicting what's going to happen in the future. Taking it day by day, week by week, and not really thinking too much what's going to happen in a year or 5 years from now. Yes, we need to have some high level understanding on where we're going, but at the end of the day, I think it's really just understanding on a day-to-day, week by week basis on what we have on our plate from a risk reward standpoint. So hope you all enjoyed this video and found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Definitely do check out the links down below for our Instagram. Connect with me there. All the lifetime access courses, fundamentals, technology, technical analysis, options, and psychology. And definitely do check out our Patreon and our Discord. Limited access, limited spots left. You get access to everything that's available for the community members. As always, happy investing. I'll see you all in the next video.